The number one question I'm getting in my inbox right now is this. If the dollar is really losing its grip on the world, why isn't anyone on CNBC talking about it? And that question, that exact frustration, is the signal that you're paying attention to the right thing. Because what I'm about to walk you through is not being explained to retail investors the way it should be. While the financial media has you staring at the latest jobs report and arguing about whether we're in a recession, two of the largest structural forces in modern financial history are converging in the exact same window. One is the slow, deliberate retirement of the US dollar as the world's settlement currency. The other is the most aggressive interest rate cut cycle we've seen in over a decade. Both are arriving right now. Both are pointing at the same conclusion. And almost nobody in mainstream finance is connecting the two.
Let me pull back the curtain on what's actually happening, because the world just missed the signal, and once you see it, you cannot unsee it. Welcome back. I am the Calm Analyst, and around here we don't trade on emotion, we decode structure. Today we examine what happens when the global reserve currency loses its monopoly at the exact moment trillions of dollars are about to be flushed out of cash and into risk-on assets. Before we go under the surface, this is not financial advice. This is educational analysis. In this briefing, we examine why XRP sits at the precise intersection of both forces and what that structural positioning actually means. Let's jump in. Let's start with the hard truth. 97% of retail investors are staring at price charts. They're watching candles, refreshing CoinMarketCap, arguing in comment sections about whether XRP will ever move. If you're wondering why nothing seems to make sense, why the fundamentals look stronger than ever but the price refuses to cooperate, you need to understand something that the crowd has never been taught. You need to understand the petrodollar system, and more importantly, you need to understand that it is being quietly dismantled right now. For 50 years, the global financial system has run on a single architectural pillar. In the 1970s, the United States made an arrangement with Saudi Arabia and the other major oil producers. The deal was simple. Oil would be sold exclusively in US dollars. Every nation on Earth that needed to buy energy, which is every nation on Earth, had to first acquire dollars to do it. That created permanent, structural, non-negotiable demand for the dollar. It is the single reason the United States has been able to run $35 trillion in debt without consequence. It is the reason the dollar has remained the global reserve currency for half a century. That arrangement is fragmenting in real time. Here's what retail doesn't see. Saudi Arabia has openly discussed accepting non-dollar currencies for oil settlements. The UAE, one of the largest energy producers on the planet, has been signaling a structural pivot away from dollar-only settlement architecture. China and Russia are now settling bilateral trade in yuan and rubles. India has built parallel settlement corridors that bypass the dollar entirely. The BRICS bloc, Brazil, Russia, India, China, South Africa, and the newly added member states, is constructing a shared payment infrastructure designed specifically to route around the US dollar. And here's the move that should make every serious analyst sit up straight. Central banks around the world are buying gold at the fastest pace in modern recorded history. When a central bank, the most informed financial entity inside a sovereign nation, chooses to hold gold instead of US treasuries, they are not making an emotional decision. They are quietly signaling that they no longer trust the dollar to hold its purchasing power over the long arc. That is not retail panic. That is sovereign-level repositioning. This isn't anti-American. This isn't political. It is structural. The world is looking at $35 trillion in US debt, the velocity at which new dollars are being printed, and the risk of being on the wrong side of US sanctions. And they are quietly building alternatives. So here's the foundational question. If the world is moving off the dollar as the global settlement layer, what do they move to? Because that answer is the entire thesis. Let's do the math the retail crowd ignores. Global cross-border payments move approximately $150 trillion annually. The foreign exchange market clears $7.5 trillion every single day. The global derivatives market sits at roughly 1.2 quadrillion in notional value, and locked inside what's called the Nostro Vostro system, the pre-funded accounts that banks hold at other banks to enable international settlement. There is approximately $27 trillion sitting idle. That's $27 trillion of dead capital, parked across thousands of correspondent banking relationships, doing nothing. Now here's the math. If the world transitions even a fraction of that settlement infrastructure to a neutral digital bridge asset, the demand requirement is staggering. XRP has a fixed total supply of 100 billion tokens. That number does not change. Roughly 55 to 57 billion are in circulation. A meaningful portion has been lost to forgotten wallets, dead keys, and locked institutional holdings that will not return to the open market. The escrow mechanism releases 1 billion tokens per month, but historically the vast majority is relocked, meaning the actual net release is a fraction of what the headline number suggests. Think about that math. Fixed cap 100 billion. Lost or permanently locked, a meaningful fraction. Re-escrowed monthly, the majority of releases. The liquid available supply is significantly smaller than the casual observer would assume. Now apply the settlement equation. If you want to move $1 billion of value through a bridge asset priced at $3, you need roughly 330 million tokens of liquidity. But at $30, that same transfer only requires 33 million tokens. At $300, 3.3 million. The higher the unit price of the bridge asset, the less slippage, the less liquidity is required, the more efficient the corridor. This is not a price prediction. This is a design requirement of the system itself. A neutral settlement asset that has to absorb trillions of dollars of global flow cannot remain at retail-friendly price points. The math simply does not work. If XRP captures even 0.5% of the cross-border payments market, just 0.5% of 150 trillion, we are talking about $750 billion of annual settlement flow. Map that against a shrinking liquid supply and you do not get a prediction. You get a requirement. If you have a problem with these numbers, you don't have a problem with me. You have a problem with arithmetic. While retail is panic selling on every red candle, the institutional signal has never been louder. Let me walk you through what the silent actors are actually doing. Ripple was just granted a federal banking license from the OCC, the Office of the Comptroller of the Currency, which is the United States agency that regulates national banks. That is not a press release. That is a structural integration into the U.S. banking system itself. Ripple is no longer an outsider asking for permission. Ripple is now inside the regulatory perimeter. Ripple acquired G-Treasury, the cash management software that runs daily treasury operations for Fortune 500 companies, including Subway and a long list of multinational corporations. They acquired Hidden Road, one of the largest prime brokerages serving institutional clients. They are not building toys for retail traders. They are building the plumbing for institutional money flow. RLUSD, Ripple's own dollar-pegged stablecoin, has crossed the $1 billion mark in circulation. That stablecoin doesn't just sit in a wallet. It functions as the dollar-denominated settlement instrument inside a system whose bridge asset is XRP. Two halves of the same architecture. Ask yourself a brutal question. Does a firm that just integrated into the federal banking system, acquired a Fortune 500 treasury platform, acquired a major prime brokerage, and launched a regulated stablecoin, does that firm move without absolute legal certainty about where this is headed? Absolutely not. They don't gamble. They position. Look at the broader institutional landscape. BlackRock, Fidelity, and Franklin Templeton have been quietly building digital asset infrastructure. The Bank of Japan, and the Bank for International Settlements have been running settlement pilots on neutral bridge architecture. The IMF has openly discussed the need for a non-sovereign settlement layer in a multipolar currency world. Larry Fink, who runs the largest asset manager on the planet, has publicly stated that tokenization is the next generation of markets. That is not a speculative comment. That is a man who manages roughly $11 trillion, telling you exactly where the rails are being laid. And here is what on-chain data from Glassnode and CryptoQuant has been showing. Exchange reserves for XRP have been trending toward multi-year lows. Tokens are leaving exchanges and moving into custody. That is not retail accumulation. That is institutional positioning into cold storage, which by definition is not coming back to market for a 10% trade. This isn't FOMO. This is calculated accumulation by custodians who already know what's coming. Now let me layer the second force on top of the first, because this is where most analysts completely miss the picture. At the exact moment the world is moving off the dollar as the global settlement layer, the Federal Reserve is entering one of the most aggressive rate cut cycles in modern history. The Fed sets the level of interest rates that ripple through the entire economy. When rates are high, money sits in safe places, savings accounts, treasuries, money market funds, because cash is paying you to wait. When rates are cut, the math reverses. Cash stops earning enough to outpace inflation, and capital rotates out of safe assets and into risk-on assets that have the potential to grow. This pattern has played out every single time the Fed has entered a cutting cycle for the last 50 years. The size and speed of the rotation depends on how aggressive the cuts are. And the signaling right now points toward aggressive. Here is the part the financial media is not connecting. When the Fed cuts rates into a market where the dollar is also losing its global settlement monopoly, you do not get a normal capital rotation. You get a structural capital rotation, because the cash that's leaving treasuries and money markets is not just looking for yield. It's looking for assets that are positioned to benefit from a fundamentally restructured global financial system. Trillions of dollars are about to be flushed out of cash. Some of it will go into stocks. Some of it will go into gold and silver. Some of it will go into real estate. Some of it will go into Bitcoin as a non-sovereign store of value. And a portion of it, a portion that the institutions are already preparing for, will flow into the settlement infrastructure that the post-dollar world will run on. Most assets get one tailwind. Stocks benefit from rate cuts, but not from de-dollarization. Gold benefits from de-dollarization, but not from the same risk-on rotation. Bitcoin benefits as a store of value, but is not the settlement layer. XRP is positioned to absorb both forces simultaneously. It is a risk-on asset that benefits from a rate cut rotation, and it is a neutral settlement bridge that benefits from de-dollarization. That dual positioning is not an accident. That is the result of nearly 15 years of architectural design by a team that understood exactly where this was headed. This isn't a Moonboy fantasy. It is the logical consequence of two macro forces converging on a single asset class. Let me name the specific catalysts that are about to compress this entire setup into a much shorter window than most people realize. The Digital Asset Market Clarity Act is the final regulatory green light that institutions have been waiting on. Once jurisdictional clarity between the SEC and the CFTC is codified, the risk premium that has kept institutional capital on the sidelines disappears. The wait-and-see money becomes the all-in money, and that transition does not happen gradually. It happens in a window. Spot ETF flows are the second catalyst. Once an XRP spot ETF is fully operational and trading across major U.S. brokerage platforms, the addressable capital pool expands by orders of magnitude. Pension funds, registered investment advisors, and 401k allocators that are currently structurally prohibited from holding the underlying asset suddenly gain access. That is not a small unlock. That is the institutional gate opening. Federal Reserve policy is the third. The next several rate cut decisions are going to determine the velocity at which trillions rotate out of cash. Aggressive cuts compress the timeline. Cautious cuts extend it. Either way, The direction is set. The fourth catalyst is the continued fragmentation of the petrodollar arrangement. Every new bilateral settlement deal between major economies that bypasses the dollar adds another structural data point. There is no single dramatic moment of collapse. There is a steady, deliberate drift, and that drift is accelerating. When you stack these four catalysts on top of each other and recognize that they are all maturing inside the same 18 to 36-month window, you start to understand why the institutional positioning has been so urgent and so quiet. They are not waiting for the catalysts to land. They are positioning before the catalysts land. Because once the catalysts land, the price discovery happens in a vacuum of available supply. We are moving from an era of abundance to an era of scarcity, and most retail investors will not understand what that phrase means until it's already happened to them. Right now, you can still buy whole XRP tokens. Right now, the price still feels accessible. Right now, exchange reserves are at multi-year lows, but there is still liquid supply available on the open market. That window is closing faster than the casual observer realizes. Once tokens move into institutional custody, into multi-signature vaults, into ETF cold storage, into corporate treasury holdings, they do not come back to market for a 10% profit. They are functionally removed from circulating supply. Every billion-dollar institutional allocation permanently shrinks the available float. When the regulatory clarity arrives and the risk premium evaporates, the price does not move smoothly. It gaps. That is what happens when an asset that has been artificially suppressed by uncertainty suddenly has the uncertainty removed. The bid-ask spread compresses, market makers reprice in real time, and the retail entry points that existed yesterday no longer exist today. The institutions have spent years positioning quietly so they can be in before the door closes. The financial media has spent years convincing retail to look the other way. That is not a coincidence. That is how every major asset repricing in financial history has worked. The accumulation phase is always boring. The accumulation phase is always painful for the people holding. The accumulation phase is always characterized by red candles, fake headlines, and constant doubt. And then the accumulation phase ends. Once the final switch is flipped, the people who were waiting for confirmation become the exit liquidity for the people who were positioned during the uncertainty. The door is closing fast. I know watching the chart right now is painful. I know the headlines create fear. I know every red day feels like confirmation that maybe you're wrong about this whole thesis. But as an analyst, I am trained to distinguish between noise and signal. The price action right now is noise. The architecture being built underneath it is signal. The regulatory chess being played in Washington is signal. The OCC banking license is signal. The G Treasury acquisition is signal. The RLUSD crossing $1 billion in circulation is signal. The exchange reserves trending to multi-year lows is signal. The central bank gold accumulation is signal. The BRICS payment infrastructure is signal. The fragmentation of the petrodollar is signal. The red candles are the smokescreen. The boredom is the silence of a predator waiting to strike. Being early feels exactly like being wrong, right up until the moment reality catches up. The question isn't whether the thesis plays out. The question is whether you'll still be holding when the institutions start repricing the asset to match the role it was designed to play. Because once that repricing begins, there is no second entry point at today's levels. There is only the chart in retrospect, and the regret of the people who watched it happen. History does not reward comfort. It rewards the people who paid attention when the room was quiet. Two forces, one window, one asset positioned at the precise intersection. The dollar's slow retirement from the global settlement layer. The Fed's aggressive rate cut cycle pushing trillions out of cash. These are not separate stories. They are the same story, told from two different angles, and they are both pointing at the same conclusion. Price is a distraction. Architecture is the reality. The retail crowd is watching the price. The informed are watching the structure. And you, by sitting through this entire breakdown, have already separated yourself from the noise. If you understood this analysis, drop the word architecture in the comments below. I want to see who actually made it to the end and who's actually paying attention to what matters. In a market fueled by emotion and short-term thinking, we thrive on data and composure. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete. I am the calm analyst. Knowledge is the only hedge. Stay sharp. Stay positioned.